element to starting your business is finding the best way to fund your new operation. For the first few years of operations, it can be difficult for new businesses to keep enough cash on hand to continue operating smoothly. For this reason, starting a business involves a great deal of financial risk. It is quite common to underestimate the cost of starting a business. You need to carefully consider and list out all the costs before starting. Let's start by talking about startup cost. Startup cost is every expense that you will incur before opening your doors. Essentially, it is everything that you have to pay out to get the business up and running. Some examples of startup costs are legal or professional services, utility deposits, initial inventory, furniture and fixtures, equipment, and software charges. It is important that you sit down and list out every potential cost. The next consideration in determining how much financing you need to start your business is looking at your initial operating costs. These are expenses that must be covered whether or not you have any sales. Some examples include rent, wages, insurance, or utility bills. These are typically fixed costs, meaning that the price is consistent regardless of sales volume. Another thing to consider when creating a plan to fund your business is working capital. Working capital is the cash that you need to cover expenses within any given business cycle. Some examples of working capital include accounts receivable, payments on inventory, payroll, and taxes. These expenses may vary depending on your sales volume, but not necessarily. It is typically recommended to have 6 to 9 months of working capital in the bank when you start out. Now that you've figured out how much money you need to get the business started, the next question to ask is, where are you going to come up with the money? Funding for a business usually comes in two forms: debt and equity. Debt is obtained by borrowing and must be repaid from cash flow. Equity financing is contributed by owners or investors and is not repaid from operations. The easiest way to start is complete equity financing, where the owners put up their own personal funds or savings. Many business owners are not fortunate enough to have all the funds they need to start out from the very beginning. To subsidize their own funds, some people will find funding from friends or family. This could be in the form of low-interest loan or sometimes in the form of gift. If you are seeking funding from friends and family, it is best to get the terms of everything in writing to avoid any disagreements in the future. One of the most common sources of funding we see is bank financing, or taking out a loan from a lender. We'll talk a little bit more about typical lending requirements in just a minute. There are several other sources of funding like crowdfunding, supplier credit, refinancing a home, or finding private investors. It might be difficult to find the best route to fund your new business. We are happy to help answer questions. One question we get asked pretty often is, are grants available to help me start my business? In most cases, the answer is no. There are some private foundation grants, but these are usually highly competitive, where thousands of people are competing for a $5,000 prize. There are also some national grant programs, but these are usually for high technology development. Think about things that the Department of Defense or the National Institute of Health would want to purchase. For most businesses, you shouldn't rely on grant funding to get started. As I mentioned a minute ago, bank financing is one of the most common ways to start your business. Let's look a bit deeper at what loan applications require. Requirements do vary slightly depending on the lender and how the loan is structured. Most new businesses will have a loan that is backed by the Small Business Administration. When you approach your lender for a new business loan, they will typically need a copy of your business plan and projected financial statements going out at least 3 years. Lenders will usually conduct some sort of interview with you, perform personal credit checks, and typically take some collateral. Lenders also require that you contribute financially to the business. In most cases, the lenders will be looking for 20 to 25% of the entire startup cost to come from your personal funds.